Welcome back, everyone. Welcome back. Bienvenidos a todos. I'm glad you're here, back again. As usual, you could have been on YouTube watching anything. You could have been watching a dog that don't trust nobody or no one, not even his own foot. Or you could have been watching the reason I don't like or trust cats.
You guys, this is Shiva. I wrote her in today because I'm telling you she's a better person.
But you're back here with me, and for that I'm grateful. You know, gratitude is always the only attitude. Today's going to be something a bit different. As you can tell, I'm at work, which is the main reason why there's a big delay in my videos. So I thought, you know what, I may as well start doing them here as well. I'm just going to be recapping everything I've learned this year, as this is coming up to a year that I've been investing now. So just going to go over, you know, the highs and the lows, the goods and the bad, the wins and not losses, the lessons. Learned a lot along the way. So yeah, just going to recap everything. So roll the credits and I'll be back in a sec. Right, the first of many things I learned this year was not to spread your money too thin. Funnily enough, me and my friend Barzy was talking about this the other day. It was good, Barzy, if you're watching. Yeah, and when I started, I only put £20 in when I started this because I was only doing it to do the referral scheme for my friend, just so he got a free share. My friend Jerome. What's good, Jerome? So yeah, I put that in. And I just thought, well, I got the app now, let me play around. And I must have literally bought about 10 companies with that £20, putting £2 on each. And obviously that's not going to get you very far. So I actually got into it, and then I put in £50. And I think I only split that 2 ways. But before I know it, I was buying loads of companies and putting minimum in and getting peed off when it was only bringing me back 2 pence or 3 pence on each one. Like, what really did I expect, you know? So that was a lesson I learned. So even now, if I'm in a position where, say, I'm putting £1,000 into my account, that may just go on one stock, depending what it is, at the most 2. So yeah, that was the first lesson I learned. And if you're jumping into the stock market now, definitely do not spread your money thin. Which takes me to my next point, which is don't buy every stock that you like. It's very easy to do so, especially if you like a certain sector. Like if you're into electric vehicles, before you know it, you would have bought Tesla, NIO, Churchill Capital, which is changing to Lucid Motors, and all the others that's coming, like Arrival and all the other EV companies. It's very easy to get sucked in, and before you know it, you're overweight in one sector. Your portfolio wouldn't be as diverse as it should be. So beware of that trap. That's very easy to do. Plus, it goes back to the previous point, you know, about spreading your money too thin. Me personally, in a particular sector, I'll hold no more than 3 stocks. Otherwise, I just end up overweight in that sector in my portfolio, and I try to keep it as balanced as possible now. Right, another lesson I learned was always do your own due diligence. I can't say this or stress this often enough. It is vital that you do so, which leads me to my next point, is don't blindly follow YouTubers, because sometimes they get it wrong. We're all human. They'll suggest something to you and you don't know what's around the corner. And also, unfortunately, some of them are being paid to pump and dump, hype up companies. I don't know if you've seen it. There was an issue a few months ago where quite a few of the popular YouTubers were proven to be paid to promote certain companies which were dog shit.
Fucking liar!
So everyone's got their own agenda. So, you know, always do your own due diligence, because it's all good when you're making money, but when you lose money, you ain't got no one to blame but yourself. You can't be, you know, hurling insults at them. It was you that pressed the buy button. It was you that worked for your money, and it was you that pressed the buy button. So always do your own due diligence. What's that saying? A fool and his money will soon part company. So, you know, do your DD, always. Also, if you've done your due diligence, you should always buy the dip. Always buy the dip. If you've done your DD and you know it's a good company and the price has gone down, it could be for reasons outside of the company's control. There might be a general sell-off in that sector. Could be market manipulation. It could be down to a variety of things. So if you love the share at, say, $20, there's no reason you shouldn't love it even more at 15 or 10. Buy more. The stock market's the only place where, and the crypto market, where people complain when things are down. And that shows me that people really don't know what they're doing. Because if you went shopping to, say, your favorite, I don't know, designer shop, and the pair of jeans you'd been eyeing up for ages and suddenly go on sale, you would not complain. You would buy it. You'd probably buy more. So why is it when it comes to investments and they go down, you want to complain with your ungrateful self? No, buy more. Also, what I've learned is always have an entry point and an exit plan. It is very important that you do that. It takes so much stress out of investing if you do that. If you see a price is going, a share's going for argument's sake, it's $25, but you're saying to yourself, that's too much. If it hits 20, I'll buy it. You can also automate the whole thing. Set a buy order to automatically buy at $20, because that's what you feel it's worth. Set the amount you want to buy, and have an exit plan in mind. You might just want to double up your money, so you might set it at $40 and it will sell automatically. It takes the whole stress out of investing. No need to keep checking your phone every day, seeing if it's gone up or down, stressing with the fluctuations. You can just set it and forget it. So I recommend doing that. With certain stocks I do that, and it just, you know, takes the worries out. Others I like to watch on a daily basis, and so I can see how they perform, you know, for my own research. But that's another suggestion of mine. Plus, I tell you what happens if you don't have an exit plan, and you will end up losing money guaranteed. I've done it, and that's why I'm kind of strict with it now. And that's because you'll buy a share, I don't know, example again, $20. It starts to hit 30, 40, and you're thinking, oh, maybe I should take my money out because it might go back down. But then you keep seeing it go up, and, you know, FOMO, you don't want to miss out, so it keeps going up. And then one day when you're not looking, bam, it plummets. And you're back down to what you put in, or it's dropped even worse, less, and now you're in the red. And now you've got no choice but to become a long-term investor or lose money, because you're gonna have to wait for that share to go back up just for you to break even now. Or you have to wait even further for it to go up in profit. And what you intended to be a quick flip is now a long process, and you're a long-term investor. So always have that exit strategy. And if you have it, you've got a figure in your head, set a sell limit order and be done with it. Otherwise, yeah, you're going to become a long-term investor when you wanted to be a swing trader. Also, 2 things that helped me be a better investor this year is learning to read Fibonacci charts and candlesticks. Fibonacci charts will help you to find a very good entry, and also a time when maybe you should leave. And if you're not leaving, then you're going to find when the next level of support and resistance is going to be. Research Fibonacci charts. It will help you out a lot to find, because you might look at a stock and figure you want to get in now, but, you know, looking at those charts, it will tell you, nope, stock price is actually running too high and you might need to come back down. And that also brings up what they called RSI, the relative strength index. You want to look at that to see if something's overbought or oversold. That will also help you decide whether you should jump into a stock at the current time. And the candlesticks, once you learn to work out the pattern, you can't predict what's going to happen next. Otherwise, we'd all just learn candlesticks and become millionaires. But you can kind of detect trends and almost have more than a guess of what's going to come next. So yeah, those three things, RSI, Fibonacci charts, and candlesticks. Learn them. Ain't gonna lie to you, it's boring as hell, some of the research you gotta do, but you know, you wanna be rich or not. Right, on the move again. Another thing you've really got to do is check out the management of whatever company you're investing in. It is such an underrated part of doing your DD, because when you check it, if you're buying Tesla, are you really buying into Tesla, or are you buying into Elon Musk? You know, like, who would really be interested in Berkshire Hathaway when Warren Buffett passes? Anyway, I'm not hoping that happens. Hope he lives a long, prosperous life, but you know what I mean. Yeah. My point is, when you buy certain companies, you're actually buying into the management. No Elon, no Tesla. No Warren Buffett, no Berkshire Hathaway. So think how the company would survive if something happened to them. Personally, I don't know about Tesla. You don't really know I never really see who's the second in charge. With other companies you do, like with Apple and whatnot. But yeah, look into that. Another thing I've learned is to diversify your portfolio, but not just in sectors like energy or EV or banking or wherever, but you want to also diversify them in market cap sizes, from, you know, mega cap like Amazon, Tesla, Apple, down to your penny stocks. You want to have a variety, because that way you can manage your risk, depending on your risk tolerance still. If you're, you know, risk averse and whatnot, you might want to put a lot into penny stocks, but it's not a good idea, I don't think, especially as a new investor. You want to have some mega caps in there and everything in between. Also, when diversifying, you want to do the same with countries. Don't just have everything on the, you know, on the NASDAQ and whatnot. Have some on the LSE, the London Stock Exchange, the FTSE, 100 and 250. Have some on the CAC, DAX, you know, the French and German ones. Be very diversified, so if a problem hits a country, at least you won't be too affected. You'll still have money in other sectors and areas. So yeah, diversification. Very big lesson I learned in 2020. Ain't making them mistakes in 2021, no way. Also, don't get emotionally attached to stocks. Once they've stopped serving your purpose, bin them off, get rid. Because that's something I did at the start, which I paid the price for. You get emotionally attached to them, whether you bought the stock on a particular day, like a birthday or something that it had meaning to you. And there could be a variety of reasons why, you know, you get emotionally attached to a stock. Maybe it was the first one you ever bought. But once they've stopped serving you, bin them off. You know, they're working for you. Once they've stopped serving their purpose, they're not needed. For instance, like AT&T, I kept them. That was going to be one of my long play dividend stocks. But once they started mentioning about they're going to cut the dividend, that's it. They can go. No need to be no more. I'll find another stock to take its place in the portfolio. There'll always be other stocks. So yeah, no emotional attachment to stocks. I think I said it before, but I'm not sure. Basically, do not buy a stock that you don't intend to hold for a minimum of, say, a year. Because even if your objective is to swing trade the stock, it could be a dog shit company, but you've heard you can make some money in it. You know, turn 1 to 2 real quick. But if that doesn't happen, now you're a long-term investor in this company because it's gone into the red and it's either sell at a loss or average down, so you've got to put more money into it, what you didn't want to do, or you're going to have to keep it. So yeah, if you don't have the intention of keeping the stock, if it ain't going to pee you off seeing it in your portfolio, then don't do it. because not all swing trades work. One thing I suggest you all do is what I did, and oh man, it's paid dividends for me. And that is, even if it's your first day investing, your first week, it doesn't matter. Talk to your friends about it. Try to bring them in, because 2 heads are better than 1. Imagine 3, 4, 5, 6. When you've got a group of people that you can talk to about stocks and bounce ideas off, something you've learned today you could share with your friends, and they're going to bring things they've shared with you. And trust me, you're going to find yourself investing in sectors and companies you didn't even know about, and your knowledge of the stock market will grow twice as quick. So that's one thing I've done. Luckily, I'm in about 3 different WhatsApp groups where, you know, we just bounce information off till early hours in the morning. Something like my phone's just constantly pinging. And yeah, that should be something you look to do yourself. And you know, if you haven't got people you can talk to, go on Facebook, join groups. There's 1,001 different groups on there talking about stocks, crypto, wealth in general. So definitely do that. Yeah, and the people you're gonna meet along the way, the knowledge you're gonna get, oh man, it really pays dividends. Like, I would not be where I am now if it wasn't for my friends, or if I wasn't sharing info that I had, because the info that I've been getting back in return has been so helpful. So yeah, you know, certain businesses where people like to keep things to themselves and be the only one with the knowledge and not want to tell no one and get rich alone, where the stock market doesn't work like that. It benefits for you to share what you know, other people buying stocks you're into as well. Do you know what I mean? Yeah, really, it pays dividends. So yeah, definitely try to bring people in around you and share what you know. Plus, back on diversification, what I missed out is, me personally, what I'm doing is, I've decided out of 100%, 75% of my portfolio is going to be stocks and shares. 20% is going to be crypto. And the remaining 5% I'm going to put in precious metals. I'm going to buy gold and store it and whatnot. Don't ask me where, because I ain't telling you for shit. But yeah, you want to have some precious metals in there. Don't watch when they say gold's going down and blah, blah, blah. Gold will always be gold. And if the world turned to shit, gold would still have its value. Everything else may not have. When the world's, you know, on its knees and needs certain resources and that, no one ain't going to be asking you about crypto and none of that. They're going to be asking about gold and precious metals. So make sure you do get involved in that. That's my percentage, 75, 20, and 5. Yours may be different. You may be heavily into crypto. You might have a higher risk tolerance than me. So if that's the case, you want to go for crypto. You're going to make quicker and possibly higher gains, but the swings are just crazy in it. So it's up to you how you do it, but that's just how I'm going to diversify. Right, I better wrap up this video. I ain't done much work today. They don't pay me to sit here and make videos. But anyway, one of the most important things I've learned this year, or that's changed me rather, is investing. Because if you invest right and you read good books along the way, like Rich Dad Poor Dad, I'm telling you, that book is really good. If you ain't read it, definitely read it. But it changes your relationship with money, and that's what I find investing does. And I'm very glad of that fact, because I no longer save for anything. Because to a certain extent, if you've got to save for something, you can't afford it. And that's what I realized. The better way of thinking is to make your dividends and your assets pay for all the luxuries you want in life. When you break things down to assets and liabilities, most of the things we want are liabilities. And only buy those liabilities when your assets can buy them for you, rather than money you've worked hard for. So I'm glad investing has opened my eyes to that. So I recommend reading that book. And yeah, like I said, I'm going to wrap this up now. Call it a day. I better go and do some work before I finish. But yeah, that's basically most of the things I've learned this year through my first year investing, May till May. I know there's probably a few things I've missed out, but that's it in a nutshell. And yeah, onwards and upwards from here. hopefully the same for you guys. Any mistakes I've made, I'll gladly put them out there so you don't have to make them as well. And yeah, let's get this money together. So yeah, back to work, and I'm gonna make another video hopefully next week. So hasta la semana próxima. Adios. Oh, PS, I nearly forgot. Please subscribe and like the video. All of that really helps me out big time. I need help with that YouTube algorithm. So yeah, once you're done, finish the video, please hit that like button. Look at that lovely sunset. Anyway, hasta la semana próxima. Adios.